Welcome to track 12 of the Brian Chung podcast, where I share stories, interviews, adversities, successes, wins, and losses. This track is about fixed versus variable mortgage rates and what happens when the prime rate drops. I won't get into how a mortgage is defined, but feel free to Google it if you like. So, what is a fixed mortgage rate? A fixed mortgage rate is basically where you borrow money from a bank for a fixed period of time. Common terms you will hear are 2, 3, and 5 year terms, but there are many other options. The majority of Canadians perceive fixed rates as safer, and therefore more than 60% of homeowners are in this type of mortgage. Rates of this type are set for a duration of the term, as mentioned, such as 2.64% over 5 years. So what is a variable rate mortgage? First, there are two types of variable mortgages: an open term and a closed term. An open term allows you to pay off the mortgage with minimal penalty, sometimes a nominal admin fee, which allows for a lot of flexibility. For example, if someone wanted to fix up and sell an investment property, you're most likely going to renovate, and basically you want to be able to have the most flexible terms to renovate, fix, and sell as quickly as possible. Okay? The more common variable mortgage now that's out there on the market is a closed variable type. This means the interest rate fluctuates as the prime rate fluctuates. When prime rate goes down, like the environment we're experiencing right now, each payment results in more being paid back to the principal and less to the portion of the interest. If prime rate goes up, the opposite happens. You pay more interest with every payment and less to the principal. This also means your equity won't get built up as quickly. These terms are typically in 5-year terms. However, the length of the term can be very similar with other fixed rates. Please make sure you read the fine print. Some variable types of mortgages keep the payments the same, while other types fluctuate the payment as the rate changes. So, we've all been hearing lately about the interest rates going down and the Bank of Canada, along with the US Federal Reserve, lowering their interest rates. What does it mean when prime has gone down, or when the Bank of Canada lowers its target for the overnight lending rate? This rate is used to help Canada as a country manage the overall liquidity in the Canadian banking system, meaning banks can obtain money from the Bank of Canada cheaper with these rate drops. And in turn, what should happen is that these cheaper rates should trickle down to the end consumer and the businesses that need it the most. So what impact does it have on my current mortgage? This impact and the rate will all depend on whether or not your mortgage is of the variable type, open or closed, that uses the prime rate as a benchmark. These rate drops will impact home lines of credits, other lines of credits, and HELOCs. Remember, the bank who you're borrowing from must have also lowered their prime rates for your loans to be affected, okay? So the next thing people ask about, well, what about penalties? Well, most of the mortgages, but not all, generally have two types of calculations as they relate to penalties, okay? Let's talk first about the fixed mortgages, the ones that most Canadians have. If you read the fine print, many of these penalties use complex calculations to determine the amount, okay? They are called IRD, or interest rate differentials. Two key parts of this equation are: what is the time remaining in the months until your mortgage matures? And 2, what is the discount rate that you receive relative to the posted rates? I won't go into the nitty-gritty details here, But this could result in thousands of dollars to tens of thousands, depending again on the size of your mortgage, the time remaining, and the discount that you receive. So before you call up your bank or your financial institution about switching over because rates have dropped, you should think again, okay? Now for the variable parts of the mortgages, mainly for the closed types. These penalties typically are 3 months of interest. Currently, as I type this, many of you will want to be staying in these type of mortgages since the rates are so low due to the last recent 2 drops in prime rates. However, as prime rates increase, along with the variable rates, and at the same time fixed rates drop, there could be some mortgage interest saving opportunities that lie ahead. In this environment, currently there are none, but if that happens, you may be able to pay a penalty and then lock in to these lower fixed rates. I hope you found this podcast valuable, and now you understand a little bit more about fixed rates and variable rates, as well as what's happening with the recent prime rate drops a little bit better. Thank you again for listening to my podcast. If you like what you just heard, please subscribe. Thank you. Until next time, Brian out.